For my new subscribers, I do videos every single day. I usually do 3. And if you look at the bottom of your screen where it says the description box of the YouTube video, you will see I have a link there titled Today's Playlist. If you click that link, it will bring up all 3 of my videos and they will play one after the other to make life easier for you. Okay. Again, this 12 reasons. You know, like the 12 days of Christmas? The 12 reasons why the Federal Reserve may have just made the biggest economic mistake since the last financial crisis. Michael Snyder, the Economic Collapse blog. This is not anything extraordinary. It's not like the Fed decided just, we're data dependent and we saw, like Yellen said, the data suggests, doesn't tell you, but suggests, makes a, the data can make a suggestion. Oh, it's alive. The data's alive. Like the economy. Oh, the economy didn't rebound quite as hard. The economy. The markets shrugged off Yellen's comments today. The market shrugged off. What is this, a living creature? A living being? What is this nonsense? Not that it matters, as I said. She is doing what she's supposed to be doing when she's supposed to be doing it. If this was 2015 or 2016, and let's assume Donald Trump had won and there was an election then in 2015, none of this would be happening. It only happens when it's supposed to happen. Again, everything that happens for a reason, and the reason is because the club is doing it and they want it. That's the reason. So this is like a giant movie script. You and I are in the movie. We're just like the extras, the ones no one really notices. While we all watch the club, the great actors act. And Miss Janet Yellen, head of the Fed, is acting. She's doing her part. Her script says to do this and when to do it. Do you think that woman decided on her own? I listened to my colleagues, of course, the other Federal Reserve branches, but I've decided, we're going to collectively decided right now is the right time. There's not a chance in hell. This is an agenda. And this is not going to end well. It cannot. You cannot sit here and keep raising these rates on dismal economic numbers. Retail apocalypse. Retail stores, front and center. Pensions, another video I need to talk about. Pensions. Zero Hedge. Are collapsing pensions about to bring hell to America? I may just include that actually in this one because it's quite short. But back to Michael Snyder's article. 12 reasons why the Federal Reserve may have just made the biggest economic mistake since the last financial crisis. Has the Federal Reserve gone completely insane? On Wednesday, the Fed raised interest rates for the second time in 3 months, and it signaled that more rate hikes are coming in the months ahead. And by the way, on the way home, listen to the radio, AM. Market was down. I couldn't quite hear the number. Market was down, just not a lot. Dow Jones specifically. If I can just quickly look that up, just so I haven't. Oh yeah, down 15 points. 15.55. 1555. I can't drive 55, but the Dow Jones can. Matter of fact, it's gone over 20,000 in an absurd way. 55, we're going past 20,000, baby. When the Federal Reserve lowers interest rates, it becomes less expensive to borrow money, and that tends to stimulate more economic activity. But when the Federal Reserve raises rates, that makes it more expensive to borrow money, and that tends to slow down economic activity. So why in the world is the Fed raising rates when the U.S. economy is already showing signs of slowing down dramatically? The following are 12 reasons why the Federal Reserve may have just made the biggest economic mistake since the last financial crisis. Number one, just hours before the Fed announced the rate hike, The Federal Reserve Bank of Atlanta's projection for U.S. GDP growth in the first quarter fell to just 0.9%. If that projection turns out to be accurate, this will be the weakest quarter of economic growth during which rates were hiked in 37 years. Remember, it was around 2, or 2.3 was projected out. 1.8. Nope, 1.7. Nope, 1.3 or 2, whatever. Nope, now 0.9. Talk about a revision coming. Whew. Number 2, the flow of credit is more critical to our economy than ever before, and higher rates will mean higher interest payments on adjustable rate mortgages, auto loans, and credit card debt. Needless to say, this is going to slow down the economy substantially. And while my video yesterday I talked about the adjustable rate mortgages, and I was trying desperately to find the data of how many people are getting adjustable rate mortgages these days versus 2005, 6, 7, 8. And the only article I found showed a specific month, I think of September of 08, I think. Or was it 05? Might have been 05. And then now in September, like last September, and it was like 38% of mortgages were adjustable rates then, and only 5 or 6% or something now. However, that's 1 month. So if we assume since the crisis of 08 and 09, let's just call those 2 years off, 2010, 11, 12, 13, 14, 15, 16, 7 years of 5 or 6% per month adjustable rate mortgages. That's still an awful lot of adjustable rate mortgages who just got a little notice, I'm sure. Listen, your rate just got jacked up a little bit. Oh, what's that? You just bought a new car the other day? You can't afford it? Yeah, I'm sorry about that. Sorry. And on with number 2 still. It says the Federal Reserve decision Wednesday to lift its benchmark short-term interest rate by a quarter percentage point is likely to have a domino effect across the economy as it gradually pushes up rates for everything from mortgages and credit card rates to small business loans. Consumers with credit card debt, adjustable rate mortgages, and home equity lines of credit are the most likely to be affected by a rate hike, says Greg McBride, chief analyst at Bankrate.com. He says it's the cumulative effect that's important, especially since the Fed already raised rates in December 2015 and just a few months ago in December 2016. Number 3. Number 1, number 2. Number 3. Speaking of auto loans, the number of people are defaulting on them. The number of people that are defaulting on them had already been rising even before the rate hike. The number of Americans who have stopped paying their car loans appear to be increasing, a development that has the potential to send ripple effects through the U.S. economy. Losses on subprime auto loans have spiked in the last few months. According to Stephen Ricciuto, Mizo's chief U.S. economist, they jumped to 9.1% in January, up from 7.9% in January of 2016. So year over year, from 7.9 is now up to 9.1. Recoveries on subprime auto loans also fell to just 34.8%, the worst performance in over 7 stinking years. Number 4, higher rates will likely accelerate the ongoing retail apocalypse, and we just recently learned that department stores sales are crashing by the most on record. Number 5, we have also learned recently that the number of distressed retailers in the United States is now at the highest level that we have seen since, once again, the last recession. Number 6, we have just been through the worst financial recovery in 65 years, and now the Fed's actions threaten to plunge us into a brand new crisis. There's no threaten to. It does. It's kind of like J-Stim 4's got one of those little fire starters. He's sparking off the flint, whatever. And he's doing it next to high-octane jet fuel that's spilled on the ground. Make sure I get my lingo right. Threaten to. His actions threaten to start a fire. No. His actions are absolutely going to start a fire. Let's clear that up. What the Fed has done is absolutely going to plunge us into a new crisis. The crisis was coming anyways. And now the Federal Reserve, you've got the go-ahead. We're going to deal with all these bubbles once and for all. And I was thinking, before I came over here to do this video, it just popped into my head while sitting on the couch. I wonder, the whole thing they're trying in a few countries right now. What do they call it? The monthly income. What do they call it, though? The monthly basic income. Everybody gets a basic income. And they're doing a test with thousands of people, not the whole country. But they're trying it in 2 or 3 different countries. And I thought to myself, well, back when we had mortgages in the 1900s, early 1900s, I told you, the average loan was for about, I think they said 6 years. Mortgage, 6 years. You had to have 40% to put down on average, but you had it paid off in 6 years. So naturally, you could just for simplicity, you could say, well, if you didn't have any money to put down and you were able to get a mortgage, then maybe it'd be 12 years. That'd be a fair statement. A far cry from 30-year mortgages these days. So when you have, and they said the only reason they did that was after 1929 crash, Great Depression, so that people could stay in their house. We'll make your payment super, 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 super low, and we're going to extend them for 30 years now so you can stay in your house. And then 30 years became the norm. It's now normal. There's a problem, though. We don't have fair market prices for houses in which a 30-year extension would make it great and give you really low payments because it's being extended for 30 years. You're starting off in a 30-year with exuberant prices. The price, they're over what they should be by many times, in my opinion. So now the new thing is, well, had it for almost 100 years now, almost. What are they going to do? I thought maybe they'll do the basic income. They're not going to be able to deal with the housing crisis and the rates and all this crap. They're just going to give us a basic income to help us pay for all these rising costs. But then I realized, again, you do that, you're postponing the crash again, kind of. You're giving people extra money, stimulate the economy again, and it'd be like the old shot in the arm. Need another shot. Need a shot quicker, more, faster. Nothing happens. You get to the point of no return. The point of you can put as many shots in your arm as you want. Nothing's going to change. And again, they can't have their new world currency system if they try to fix these problems for other countries. So while the basic income thing sounds good and all, the only thing that would happen as soon as if that was like a worldwide mandate and we all said, yep, we agree, we're going to do it, everyone gets $2,000 a month, every household. Let's say every household does. Guess what's going to happen to the rental rates? The housing prices, car prices, they're going to get jacked way up to compensate for that. So your $2,000 a month is now wiped out and is meaningless because all the rates of everything went up. That's exactly what would happen, which is why it won't work. Anyways, number 5, that was number 6. Number 7. U.S. consumers certainly aren't thriving, and so an economic slowdown will hit many of them extremely hard. In fact, about half of all Americans could not even write a $500 check for an unexpected emergency expense if they had to do so right now. The bond market is already crashing. Most casual observers only watch stocks, but the truth is that a bond crash almost always comes before a stock market crash. Bonds have been falling like a rock since Donald Trump's election victory, and we are not too far away from a full-blown crisis. If you follow my work on a regular basis, you know that this is a hot-button issue for me, and if bonds continue to plummet, I will be writing quite a bit on this in the weeks ahead. Number 9, on top of everything else, we could soon be facing a new debt ceiling crisis. The suspension of the debt ceiling has ended, and Donald Trump could have a very hard time finding the votes he needs to raise it. And the following comes from Bloomberg. In particular, the markets seem to be ignoring 2 vital numbers, which together could have profound consequences for global markets, 218 and 189 billion. In order to raise or suspend the debt ceiling, which will technically be reinstated on March 16th, which is tonight, I'm doing this, 218 votes are needed in the House of Representatives. The Treasury's cash balance will need to last until this happens, or the U.S. will default. The opening cash balance this month was $189 billion. That's the other number. And Treasury is burning an average of $2 billion per day with the ability to issue new debt. The redemptions of existing debt not held by the government are running north of $100 billion a month. Treasury Secretary Steven Mnuchin has acknowledged the coming deadline and encouraging Congress last week to raise the debt limit immediately, the ceiling. If something is not done soon, the federal government could be out of cash around the beginning of summer, and this could create a political crisis of unprecedented proportions. Number 10. And even if the debt ceiling is raised, that does not mean that everything is okay. It is being reported that the U.S. government revenues just experienced their largest decline since the last financial crisis. And anyways, number 11. What do corporate insiders know that the rest of us do not know? Stock purchases by corporate insiders are at the lowest level that we have seen in 3 decades. And this is from Sovereign Man. It says it's usually a good sign when the CEO of a major company is buying shares. He or she is an insider and knows what's going on, so their confidence is a positive sign. Well, according to public data filed with the Securities and Exchange Commission, insider buying is at its lowest level in 3 decades, 30 years. Again, they know. While everyone is in the stampede, oh, go, get in. Markets are great, 401k is great, I got to get in more. They're running for the exit doors. Why? Because they're the insiders, they're the club. They know well in advance. In other words, the people at the top of the corporate food chain who have privileged information about their businesses, of course, are not buying. Number 12. Which, by the way, the reason I went to look at the Dow Jones a minute ago, down 15.55, is because this is now the 3rd day in a row since that one guy, what the heck was his name? I told you he's forecasted all of the previous downfalls, the 2,900-point Dow Jones drop in September 2015. He's nailed them all and said Dow Jones 14,800 is a near future. And if we don't get to 21,800 first, it can go even below that when it comes, and it's coming soon. And he said to watch March 13th for any signs of issues leading to something like that. 3 straight days in a row, Dow Jones down, starting on the day he said to look out for. But said also don't even worry about that date anyways. The real winner not really winner, but the real one you want to look at is April 11th, I think was what he said. That's a date that has me very concerned, is what he said. So we got 2 months to get there, a little over 2 months. 12, a survey that was just released found corporate executives are extremely concerned that Donald Trump's policies could trigger a trade war. As business leaders are nearly split over the effectiveness of Washington's new leadership, they're in unison when it comes to fears over trade and immigration. Nearly all CFOs surveyed are concerned that the Trump administration's policies could trigger a trade war between the United States and China. That would happen anyways, no matter who was president. Because, whoever was president would be dealing with the same crap he's having to deal with. And as he said, I'll say it again for the millionth time, our dollar's too strong. Steven Mnuchin, our dollar's too strong. What does that mean? It means they will be devaluing. And when you devalue a dollar, it automatically equates to a trade war. Because now your exports are competing with, in this example, China's exports. And they've got slave labor over there. Their dollar, I think, is 6 to 1 or so of ours, somewhere around there. Their yuan. So if we devalue, and can you imagine, the United States is devaluing today. We would have to come out and verbally say, well, China is a currency manipulator, and that's why we're doing it. That would be our excuse. But excuses are what they are. They're excuses. They're meaningless. It's just a reason for nonsense. Nonsensical reason. The real reason is we've got too much debt, way too many treasury bonds out there held by foreigners, other people. The Federal Reserve has bought a ton of those, sitting on its balance sheet. We got a major debt problem, and this is the only way out. But we're going to not just say we're devaluing because of those reasons. We're going to say we're devaluing because China is a manipulator. We're going to say something. Not just that to get our books a little better and pay off some debt, which not the best way to pay it off, to default or lower the value of your dollar, but regardless, we're going to do something along those lines to deal with it. Trump has already talked about it. Remember, he said it. Dollar's too powerful. It's too high. So get the Federal Reserve, start raising rates. Dollar, as soon as that happened, dollar started plummeting down. Oh, exactly. A decline in global trade could deepen the economic downturns that are already going on all over the planet. For example, Brazil is already experiencing its longest and deepest recession in recorded history. I brought you that one about a month ago. And right next door, people are literally starving in Venezuela. And now, as I read recently, very recently, the government's having a problem getting the paper and whatever is necessary to make a passport. And the people are flooding out of Venezuela left and right now because they've realized the government isn't here. They can't help us, and I'm not staying any longer. I'm out. Oh, you can't leave. You don't have a passport. Let me go get a passport. No, we don't have the material. Sorry. I need to leave now. Sorry, we don't have the material. You got to stay. Despite all my rage, I am still just a rat in a cage. Remember that song? That's what those people feel like over in Venezuela. Despite all my rage, because they're raging, I'm still just a rat in a cage. I am a rat in a freaking cage in my country and I can't leave. And I know I got to get a passport and I can't. Do you know that old J Snip 4 has his passport? Mrs. J Snip 4 has her passport. Little juniors, or not my daughters, little junior, if you will, J Snip 4, all three of them, passports. Way in advance, just in case, okay? That's called preparing for situations, period. The people or sheeple in Venezuela, no, everything's fine. And then everything wasn't fine one day. After you read everything, after everything that you just read, would you say the economy is doing well? Of course not. But after raising rates on Wednesday, that is precisely what the Federal Reserve Chair Janet Yellen told the press. She said the simple message is the economy is doing well. Federal Reserve Chair Janet Yellen said at a news conference the unemployment rate has moved way down, and many more people are feeling more optimistic about their labor prospects. So hold on. Many more people are feeling more optimistic. Shortened down J-Snip 4 version. People are smoking hopium. So that's a reason for us to raise rates. They're confident. Oh, okay, that's good. However, after she was challenged with some hard economic data by a reporter, Yellen seemed to change her tune somewhat. Remember, I talked about that yesterday. So just like in 2008, the Federal Reserve really doesn't understand the economic environment. At the time, Federal Reserve Chair Ben Bernanke assured everyone that there was not going to be a recession, but when he made that statement, a recession was actually already underway. And as I have said before, I wouldn't be surprised if ultimately it was announced the GDP growth for the first quarter of 2017 was actually negative, not even 0.9. Whether it happens now or a bit later, the truth is that the U.S. economy is heading for a new recession. And the Federal Reserve has just given us a major shove in that direction. Is the Fed really so clueless about the true state of the economy, or could it be possible that they are raising rates just to hurt Donald Trump? Or both? I don't know the answer to that question, but clearly something very strange is going on. I would agree. I'm not going to go into this other video I was telling you about the pension. Our pension's about to bring hell to America. I'm not even going there right now. Done with this video. I might include it in my next one. Take care.